Welcome to Fitz Factor, the show where you learn how to master the stock market with Dan Fitzpatrick, the stock market mentor. Dan is a savvy trader. He's featured regularly on Fox Business, CNBC, Investors Business Daily, and SiriusXM Radio. In this podcast, Dan shares his insights on trading, life, and attaining long-term success in the market.
So it's looking to me like we're getting a little bit of a sell the news dynamic today. We got a good CPI print this morning. Inflation's just a little bit lower than the economists thought it was, and much lower than it was last year at this time. So, the market's kind of thinking the Fed maybe has some cover to not be continuing to raise rates. Okay, great. So the S&P is still up today. So is the NASDAQ. But I see a lot of stocks drifting lower after a strong open, and it's kind of looking like a little bit of a rest is in order. Certainly for the stocks that we're in, several of them are doing just absolutely monstrous. But then also just kind of for the broader market, the question is, are we going to go higher from here, or are we just going to go higher? And those are two different questions. So I can't cover all the stocks that I think are drifting lower today, but I'll just make a general statement that I'm hoping resonates with you. It should. Make sure you're protecting your account. Protect your profits. Have some self-awareness. Self-awareness tends to, among a trader or within the trading community, I'd have to say that self-awareness is a little bit rarer than finding an honest politician. It's just very, very few people out there that have, at least in my estimation, a good self-awareness such that they can always be looking at their positions and at the market from an objective standpoint, as opposed to what they hope and wish and pray is going to happen. So think about it this way. When you've got a real winner on your hands, or several of them at the same time, you're going to tend to get increasingly excited. You see the gains, and you're happy because they're wiping out all your losses. You've had a string of bad breaks over the last whether it's the last week, the last month, the last year. You've kind of been sticking with it. You've been still in the trenches fighting. And then finally things start to turn your way and you become really confident. And you know that you're on the right track now. So you start adding more and more to your winning positions. You bought initially at a really good level, but then as the stock starts rewarding you, you get excited and you keep buying. And when you're doing that, you're gradually raising your average cost basis in that stock. You get top heavy. You have a good starting point, but as the stock moved higher, you bought more and more. So you start looking, your trade starts looking like an upside down pyramid. And whereas the price goes up, you're buying more and more and more. I say this all the time because it applies all the time. You should be taking profits along the way. You don't have to be, in fact, in my view, you should not be all in and all out. You should always be trading in scales. You should always be focusing on managing the two sides of risk, missing the upside versus catching the downside. So if you're building a very big position, and you can even be going on margin, you should be using fractional stops at different levels to protect your downside. Now, I have no problem with anybody going on 400% portfolio margin. You can buy the world, and being long to the hilt. You're like way leveraged in this. If this is your approach, though, you're just a gunslinger. You're a gambler, and you're going to wind up losing your asterisk. But if this is your approach, you can protect against these big losses. Margin's a killer, but it can be your best friend if you use it judiciously and prudently. Know exactly how much you are risking at all times. If you're loaded to the gills with a stock, you got to be able to know exactly how much money you're risking if that stock completely implodes. Where are your stops at? How many do you have? How much of your position is tied to that particular stop? Do you have 4 of them? with 1/4 of your position on each one? Do you have a big stop? Whatever the case may be, you got to know what that is. I can't tell you. If the stock cascades lower and all your stops get hit, where do you stand? Where's your account? Have you just been decimated, or have you given back, a substantial part of your profits? Maybe you're okay. I've said many times that you can buy a stock at any time and place and still have it be a low risk trade. You get to define your risk. A low risk trade, listen to me, a low risk trade is different from a high probability trade. When you're chasing a stock that has, this sense that, I'm invincible, I'm a master trader, I'm going to be making a killing, you're in that stock, right? But the odds of it continuing to move higher without a correction go down. It could happen, of course. Maybe it's a big short squeeze, but the odds are against you. You see, when you're riding a winner, you should always ask yourself if you would buy it right now. Look at the chart and think to yourself, okay, if I didn't own this stock, would I buy it right now? If you decide that you would, then, I guess your position's okay. But what if you say, well, hell no, it's way too extended to buy here, but I'm sure glad I own it because I bought it right. Okay, if you're seeing things that way, then isn't that stock at risk of a pullback? You're buying more. You're willing to buy more of the stock, even though it is extended, but you are more confident because you already own it.
If you're getting value from this podcast, click the subscribe button and sign up for Dan's free daily videos at stockmarketmentor.com.
You say, well, if somebody didn't own it, they sure as heck wouldn't buy it here. But I do own it, so I'm right on this stock. I'm going to go buy some more stock. That just doesn't make sense. It doesn't make sense at all. Your number one thought when you're in any position, considering buying a position or adding to your position, maybe even selling your position, your number one thought should be, who is behind me? Okay, who's behind you with enough firepower to propel the stock higher from here? Not from where you bought it. Those trades have already been made. Those prices have already moved. But who is behind you with enough firepower to keep pushing the stock in your direction? Okay, that's the only way your trade makes money from here. If there's more money that wants to be exchanged for the stock, and that money wants the stock more badly than the current shareholders want money in exchange for their stock, then the price is going to go higher. Or put another way, who's more aggressive? Those that want to buy the stock or those that want to sell the stock? That tug of war is going to end one way or another. And you just need to know that. Okay, that relationship changes, though, as the stock moves higher. More and more traders that are in the stock are going to want to book profits. That's the ebb and flow of trading. And fewer traders are still willing to get into that trade. They'd rather pass completely or at least wait for a pullback. Now, as your position increases in value, you should become more cautious rather than more confident. You should understand that nothing goes up forever except taxes and our national debt, currently at $32.5 trillion and in a steep uptrend that puts the GameStop short squeeze to shame, makes it kind of look like a flat chart. So you should avoid counting your future profits on open positions because nothing's guaranteed, guys. There's no such thing as future profits. There are possibilities, there's hope, there's dreams, there's suppositions, but nothing is certain in trading other than losses. You're going to take losses. If you weren't going to take losses, then it wouldn't be called trading. It wouldn't be called speculation. It would be called winning. Okay, that's nice, but there's not too much money when there's no downside risk. Your objective is to make more on your winners than your losers and to have the highest batting average as you can. You swing at your pitch, not any pitch. And when you get on base, you run the bases with the knowledge that there are 9 players trying to put you out. Now, if you actually close a trade or until you actually close a trade, that money really isn't yours. Your chips are still on the table. Okay, you're still subject to a loss. And as Warren Buffett said, everybody's kind of heard this, be fearful when others are greedy and be greedy when others are fearful. Okay, that's fine. I think that's a good rule. But this is what you got to keep in mind. If you break that rule and you're greedy when others are greedy, you're going to get clipped. You're going to take losses. And then when that happens, it's really, really hard to be greedy when others are fearful because you're walking around shell-shocked and broke. Okay, so you're never going to get it all. You always want to be getting the in-betweens. As Dave Ryan said, he said this several times, I don't care about getting the first double. I want to get the second. And I always look at it this way. I don't try to catch the first 10% of a stock, maybe even the first 20% of a move. And I don't really try to get the last 10%. In other words, I'm not looking to buy at the low and sell at the high. I just want to get the in-betweens. You're never going to get it all. Be a risk manager rather than a risk taker, okay? Always consider the opposite side of your trade. Always ponder what institutions are doing. They're the wind beneath your wings. If an institution's selling the stock, you don't want to buy it because they got way more shares than you have dollars. So you want to be looking and say, are these institutions accumulating the stock? Okay, great. Now, if they realize that they're actually bidding against themselves, they're just buying a bunch of stock and pretty soon they realize nobody's really selling because we just have to keep buying the stock at higher and higher prices. They see that their activity by itself is pushing the stock too high, too fast. So they're going to pull their bids. They're going to step on the gas. They're going to go out for a smoke break. They're going to say, well, it's Tuesday. We've kind of got a boatload of shares and it's up way too far above the 200-day moving average or the 50-day moving average, which is what we use as references for stops. It's way up there. So you know what? We're long-term holders. We plan on holding this stinking thing for 5 years, 10 years. We got plenty of time to buy it. So let's just pull our bids, let the stock come in, let it settle down, and then we'll go start our buying campaign again. Okay, that's them. But if you're in that trade, you're going to see losses even though the stock is still under institutional accumulation because you aren't really, really in sync with what's going on. You're saying, okay, well, who's behind me? The institutions are behind me. That's great. Well, they're not behind you all the time. Sometimes they're sitting around doing nothing. And by the way, sometimes they're selling into strength, as you should be doing, even though it looks like the stock is still healthy. It's still in an uptrend. So think about it this way. Okay, it's possible to be right and still do the wrong thing. Okay, that absolutely applies to trading. And frankly, it also applies to life in general. You want to be right, but you want to be doing the right thing. And when you're wrong, the right thing is to realize you're wrong, correct your error, and then magically, you're going to be right. Okay, that's it for today. I'll see you guys next time.
Thanks for listening to Fitz Factor with Dan Fitzpatrick. If you like this, then you'll love Dan's premium service at stockmarketmentor.com, where you can learn how to trade stocks, options, and cryptocurrencies. Click the link below and get access to real-time trading alerts, a community of traders just like you, and live training sessions each week. Get the trading edge that you need at stockmarketmentor.com.